Practically, how should they be thinking about valuation in their investing journey?
I think first you need to be realistic. Investing is about preserving and growing wealth. It's not about getting rich. In fact, if you define investing as I want to get rich, you are going to crash and burn because you're going to overreach. You're going to concentrate your portfolios. You're going to make bigger bets than you should. So here's the bad news in investing. To invest, you need wealth. To get wealth, you got to do something. So if you're a doctor, spend your time as a good doctor. Don't spend the middle of your day checking out the stock pages because you think you can get rich that way. Earn an income as a doctor and use investing as a way of preserving and growing wealth. So I tell people who are not in the investment community, there's nothing wrong with being interested in markets, but you need to earn to be able to invest. You have to make sure you're not putting your earning power at risk because you're so fascinated by that next big hit you can get. Second, think incrementally, right? I mean, Warren Buffett didn't sit down in 1956 and say, I want to be a 40 billionaire. Now, he built up. And along the way, he was good, but he also got lucky. Right? He's open about admitting the fact that he hit the market at a time where it was easy to find undervalued companies because people were not digging very deep. I'm not sure that if he started in today's market and today's age, he would be able to pull it off. In fact, his advice to investors is put your money in an index fund, go back to living the rest of your life, which is actually awfully good advice for most people in investing. More time and energy and resources is wasted chasing beating the market than any other activity. So if you enjoy, so first, don't invest if you don't enjoy the process of investing. Don't invest because you expect to get rewarded. This is a game where you can do everything right and have nothing to show for it. I give people a very simple test. I say, let's say you are an active investor. You go try to find these undervalued companies. You do this year after year. You read Ben Graham's security analysis. You read every one of Warren Buffett's letters to his shareholders. You're immersed in value investing, and every year you go do your homework, you pick companies. I said, let's say you're at the age of 85, you're lying on your deathbed. And I'm a very cruel person. I show up at your deathbed with your investment track record for the last 60 years, with all the work you put in. And a competing portfolio, what would have happened if you'd just taken your money at the age of 25, put in an index fund, and left it there? The question I ask people is, would you be okay if the index fund beat you? If the answer is no, don't be an active investor. Because here's what happens. People are active investors because they think they're doing the right thing. And then they think they're entitled to earn a higher return than the neighbors who are picking stocks based on watching Jim Cramer on CNBC or reading the stars or whatever. And then they discover that their neighbor bought NVIDIA by accident 4 years ago and is rich, and they're not. And that's when bad things start to happen because you get frustrated, you get angry at markets, and then you double down. The key to remember in investing is if things don't go against you, they don't. I mean, there are too many things you don't control. You have to be okay doing everything right and not getting a reward, but you're okay with it because you enjoy the process. So one of the questions I'd ask them is, while you're listening to these shows and reading all these stuff, are you really enjoying yourself? And I enjoy looking at companies. I enjoy the business, and this is part of my life. I have to teach about these companies, but I enjoy it as a person. So to me, even if I broke even with the market, I'm okay with it because I enjoyed myself along the way. The advice that follows then is don't do things then that can create serious damage. Now, it's like the Hippocratic Oath, do no harm. Like what? Don't put all your money in 4 stocks. Why? Because you think you can get rich with 4? Because that is the pathway where you take an action, you spend all these resources, and you can end up with half the wealth of your neighbor. And that's not a good place to be. So don't overdo it. Just take it a step at a time. Enjoy the process. And if you find yourself not enjoying the process, step away. There are far better ways to live your life than chasing after stocks and getting frustrated. Now, because, it doesn't work for most people who claim to be professional investors. Why do you think it should work for you?
Love that. Well, on that note, let's move to today's market. And I want to chat about the Magnificent Seven because they're certainly capturing investors' attention, capturing headlines. But The question always turns to valuation for these ultra mega caps. So, how are you thinking about the current valuations of some of these big tech stocks? And I guess the follow on, are you actually seeing any opportunity based on valuation in the Magnificent Seven?
Let me start with the bad news. I wouldn't buy any of the seven at today's stock prices. They're fully
Nice.
valued. But at the same time, that doesn't mean much, right? I mean, the people then extrapolate from there and say, I've lost my chance. I'll never be able to own these seven companies. That's not the case. I own all seven, but I didn't buy them last year. I bought Nvidia in 2018. I bought Microsoft after its catastrophic metaverse meltdown. I bought Apple after an iPhone upgrade didn't work out. I bought Microsoft when a new CEO came and looked like they were heading to the creeks in terms of they had my Office and Windows and nothing else. And so, what the point I'm making is these are great companies. They're amazing business machines, and they're a reflection of what I call the winner take all economics of the 21st century, which is every business we look at, you're going to see one or two companies dominating because of the way we're delivering that business. I give the example of advertising. If you went back 20 or 30 years and you looked at advertising market shares, you'd see companies like the New York Times. Big market share, 3%, 4%. That was a big market share. Why? Because you were localized, you were a newspaper, you could do only so much. You could not sell the bulk of India because they didn't even read English. Today, if you look at advertising, 60% of advertising is online advertising. And if you look at online advertising as a business, two companies dominate, Google and Facebook. Everybody else is a bystander. 70% of the growth in online advertising over the last decade has gone to these two companies. And it's not because they are breaking the rules or violating antitrust laws, it's the economics of the business. When you advertise online, you want to go where everybody else is. You don't want to go to some niche platform. You want to go where hundreds of millions of people gather. So guess what? Google search and Facebook are where you go. So as businesses become more and more winner take all, you're going to see more of this phenomenon, a few companies gaining at the expense of the vast majority of smaller or mid-sized companies. Does this mean you should just buy big companies? No, that's not going to work either. If you pick the winners, of course it's going to pay off. But ahead of the fact, you don't know who the winners will be. So I would keep a list of companies that are dominating their businesses and wait for the right time. And there will be a right time. Because the nature of these companies is expectation. I mean, think of NVIDIA. People think that Jensen Huang walks on air. I mean, he is at this moment, NVIDIA is considered the greatest company of all time. That's a dangerous place to be if you're management of the company, right? Because the expectations are you're a genius, you'll figure out how to deliver 50% growth from now through eternity with 60% margins. You can't do that. There will be disappointments. So if you lost the NVIDIA bandwagon, you never got on it, and you say, oh my God, that was an opportunity gone by, bide your time. It will be cheap again, but it will mean that you got to track the company, you got to value the company, you got to understand the company. And it can't be based on what other people are doing. You'll actually be buying when they're selling. When everybody's panicked. I mean, I remember when I bought, Facebook, I still call it Facebook, Metaverse after the fiasco. People said, what are you doing? Nobody likes the company. I said, but it's got an advertising juggernaut that's going to deliver tens of billions of dollars in cash flows. Why do I care that people don't understand or don't like the company? I'm going to get the cash flows. And you can tell me whatever you want about privacy or whatever other issues you have with Facebook, but as long as people show up on the platform and the advertising is there, I get my value. So I think that part of being an investor as opposed to a trader is having a sense of what you'd like to do and biding your time. Time is your ally here. I mean, I remember Buffett saying, like, it's like he used the baseball analogy. He said it's like being a hitter in baseball, but you can never strike out. In baseball, 3 strikes, you're out. So basically, hitters have to swing with 2 strikes, otherwise they strike out. But if you can never strike out, you just stand there and stand there and stand there and wait for your pitch to come.